Hi everyone. Today I am joined by Tom Schubert, who is the managing partner and portfolio manager at Drummond Capital Partners. And today we're going to spend some time talking through what's happened in investment markets over the last quarter, reflect on some of the conversations we had last time we met, Tom, and a bit of an update on where to from here. Welcome and thanks for joining us, Tom.
Thanks for having me again, Ellie. Good to be here.
Well, the first thing that everyone is talking about, and we talked about it in our last catch up together, was the US election and the Trump effect. From your perspective, what impact is that having on markets at the moment, and what should our clients really be looking out for?
I mean, the initial impact's been positive from an investment point of view. Markets have rallied strongly post the election and through the inauguration. We have had pockets of volatility and partly that's been driven by Trump, partly by other factors, but ultimately the animal spirits are alive and well in the US, and you've seen things like small business optimism in the US tick up, US economic data and outlook improve. The market's sort of pricing in the benefit of deregulation and tax cuts, and really looking through a lot of the noise. I think we're probably better equipped collectively to deal with Trump this time, as he's less of a surprise, even though he says a lot of surprising things. I think the market is able to look through a lot of it as noise, which, it has been to some degree as well. Obviously, tariffs and trade is the big one, and we're all dusting off that playbook again. But as we saw just a couple of weeks ago, he came out. So Mexico, Canada, and China are the three biggest trading partners of the US. And on the Sunday, big announcements on tariffs. And then on Monday, walked them all back again and got what he wanted with some extra troops on the southern and northern border to stop fentanyl crossing over. So the market's digesting it well because they know that he's sort of, he uses it as a sort of blunt negotiating tool. And so it's hard at this stage to kind of bake in, long-term assumptions for the impact for his policies, other than in the short term, it's kind of good for corporate sector and confidence, and that's really, keeping the stock market on a pretty strong run.
So things look good in the US at the moment, and we've talked a lot in different sessions around, are we in a bubble? What is happening from the US perspective? What are your insights into that, Tom?
Yeah, look, valuations are certainly elevated, but when we kind of break them down and have a look under the hood, valuations in the US are trading above long-term average. So the PE, which is a measure of valuation, is trading in the US at just over 22 times versus sort of historical average of 16.5. So it's a bit elevated versus history, but that's really driven by an even greater level of valuation coming out of US growth or US tech companies. So since the ChatGPT revolution and yet another boom in large cap technology companies, both from an earnings and a capital growth perspective, valuations in that sector particularly are pushing up the valuations of the whole market just because they're such a big component of the overall market index now. However, they are growing their earnings really strongly, over 30% in 23, over 30% last year. They're forecast to grow by another 20% this year, and again next. So yes, they're expensive versus maybe long-term average, but they're fundamentally earning more and more every year. And we think that largely justifies a premium to the market. And if you strip out technology and you look at the rest of the market, it's sort of broadly in line with long-term average, and the rest of the world looks okay. So the part of the market that is expensive is making the whole market expensive. We think is justified largely by the earnings outlook for those companies.
So earnings outlook still strong for some of those companies, particularly those tech companies that you referenced there.
Yeah, and I'd say probably what we think is also a good sign of health, like we're not in a bubble, is that in 2023, a lot of the returns and the earnings were very concentrated in what has been coined the Magnificent Seven, or the big seven tech companies. Last year, that started to broaden. The rest of the market started to play a bit of catch up. And actually, when we look at the earnings outlook for this year, yes, big cap Mag 7 stocks are going to deliver about 18% earnings growth, but the rest of the market's forecast to deliver 11, which last year it did 3. So actually, the rest of the economy, the rest of the market is actually starting to participate in the expansion in the rally, and we can see that also through the economic data. So industrial data is picking up in the US. The US economic growth is accelerating. That's helping the rest of the stock market accelerate beyond just technology. And that's healthy, right? So if it was just getting really, really narrow and there's like 7 stocks doing all the heavy lifting, that can only go so far. But because it's broadening out, we feel more confident in the outlook.
A good reason to have a well-diversified portfolio, Tom?
Always.
So it sounds like it's a really good story in the US, and the outlook is looking really promising across the entire US market, not just the Magnificent Seven for the year. You talk a lot at Drummond about US exceptionalism. Why do you believe that's really important, and why that's a fundamental for continuing to have resolve in the US market?
Yeah, it's something we've written about it for a number of years. We think about it in our strategic asset allocation when we're thinking long term, so 10-year horizon of how much we should have in each asset class and each region. It's important that in that process particularly, we really try and capture those long-term themes. And traditional processes will often assume that everything just goes back to the average. So we call it mean reversion is a really simplistic way to kind of look at the world. And so a lot of people will look at the US and say, well, it's currently a bit expensive. We assume over the long term it'll go back to, not being expensive back to its average. But what we've been sort of suggesting and writing about and researching is for a number of reasons that we think the US can justify a valuation premium versus the rest of the world and Australia for a variety of reasons. And there's pretty strong evidence stacking up around that. And when we look at it high level, I mean, things like they do have a better regulatory environment, much deeper capital markets. They are pro-entrepreneurs. They celebrate success and capitalism. They don't go and knock them on the head with higher taxes like they do in Europe and Australia. So that encourages ongoing innovation and investment and growth. They've got more stable politics. I know that sounds a bit controversial because Donald Trump's just been elected, but he did, from a consistency of policy and outlook and stability, he's got the presidency, but the Republicans have got the House and the Senate. If you contrast that to somewhere like Europe, like Germany's heading into an election now, and it's like 5 different parties are all going to tussle for some sort of weird coalition. From a business investment, you're going to go invest in Germany over a 5 or 10-year horizon. Like, what does that look like from a policy standpoint? It's really unclear. And so those things continue to contrast that back to the States. You go, well, why wouldn't I invest in the biggest economy in the world with stable politics, access to cheap capital, and I know that I'm going to be celebrated for my success, not punished. And it's why they keep generating the best companies in the best sectors and the highest earnings growth. And I would say from a long-term perspective, and if you look over a 10, 15-year horizon, earnings have, shot the lights out compared to every other region and market in the world. So I think personally over a 10-year horizon, assuming that all those things hold, and right now there's no reason to think that they don't, where do you actually want to be invested? Where are you likely to get the best earnings growth, which ultimately drives stock prices higher? And it's the US. And I think in the short term, you have to be prepared to pay a little bit more for that. And that's why the US market trades a bit expensive, but why we actually capture that in our views and maintain a bias to US equities, because we think it's justified and we think we'll be rewarded for that over the long term.
And certainly have been rewarded the last period of time as well.
That's right.
Yeah. One of the other things that you have spoken about in the past is, as a metric of talking about companies that have sort of developed, that have been celebrated for really continuing to expand, is listings on share markets.
Yes.
I think that's a really good example of the difference between listings in the US and, for example, the EU. Offhand, do you have any sort of recollection of what that sort of data looks like?
Yeah, I mean, there's a great chart I saw recently, which is just showing the cumulative since basically this century, so since 2000, all of the new public companies created in the US versus Europe, and it's like by number, like $1 trillion plus companies. The EU hasn't created any, But it's like a magnitude of 5, difference between the US's creation of high value companies and that of Europe. And 25 years ago, they were, the EU having just, formed really through the 90s and been through quite a strong period of growth, was challenging the US in aggregate for global GDP weight and growth and population and, single market and all those sort of things. So it's remarkable actually how over 25 years the US has actually gone on. And it just again points to all those kind of structural differences around, a proper single market and better regulatory environment, lower taxes, pro-business, etc. So, it's hard to see that changing in the short term, and hence why we continue to invest with the US buyers.
Sounds like a really sort of promising story for the period ahead. The US obviously isn't the only exposure that you have in portfolios, though. There's obviously still a lot of other assets that you hold in the portfolio. Is that still really important to make sure we're really staying the course over time?
Of course. I mean, look, we focus our attention a fair bit from conversation and narrative around the US, and it is the case if they do sneeze, we will all catch a cold. It is the big kind of growth engine still, but we do have obviously exposure to the Australian economy. Rate cut yesterday will hopefully help activity here, potentially change of government here as well, in the same vein that we've seen in the US, may encourage the business sector out of hibernation in Australia as well. So there is some, reason to be cautiously optimistic, I guess, on the domestic economy. We added a little bit of exposure to Asia last year. China is trying to stimulate its economy, is trying to loosen regulation after a really strong crackdown over previous years. So they're, having big forums on technology. DeepSeek AI, a big challenger to ChatGPT that's arguably a lot lower cost to run, has come out recently. There seems to be further investment coming in that space. We do have some exposure there as well. Like, it's not all eggs in one basket. There's certainly other pockets of opportunity, and those things we continue to look at closely.
Yeah, excellent. So I guess key message here is stay the course, have a really good, well-rounded, diversified portfolio, but you're really focusing on the things that might drive growth over the next period ahead.
Absolutely.
Well, thanks again, Tom, for your time. It's always very insightful. I always enjoy having a conversation with you. I'm sure our clients do. And we'll see you again next quarter.
Thanks, Ellie. Good to chat.